in 50 years. So, it was free money. Okay. When you have free money, it goes somewhere. And it went into the stock market. Investors now are deciding maybe they don't want it there. Okay. And yes, the guys who claim, and there's many of them, and analysts and investors, that when the stock market goes down, so does gold. They're too much focused on a narrow event in a brief period of time. The last time of where this occurred, and they still remember it, is that October of 2008. At that point in time, gold had already been rising since its lows in price in the year 2000, 2001. It was about $260. It went up all the way to 1,000, okay, quadrupled. And that was before that collapse in the stock market. And in fact, part of that was while the stock market had already topped and was headed down. And the stock market had been dropping for a full year, and gold still rising. But in the summer, especially in October of 2008, the stock market finally had a sharp drop within the context of what was already an ongoing bear market. It dropped like 30% a month, okay, October of 2008, a year off the high. At that point, gold said, I'm going to correct too. I'll use this as a correction opportunity. And it had a collapse down into the 600s. And people think it goes with the stock market. Gold is a monetary metal. It is the inversion of the ongoing collapse in the real value of paper money units. Yens, euros, dollars, you name it. They always depreciate because governments always expand the money supply. They create free money, artificially low price of credit, and it creates distortions. And gold is merely an ongoing reflection of the decay in the monetary units that we use. That's still going on now. Money supply is still growing. It basically doubles almost every decade. And when the Fed has an excuse or justification, which is what they were created for, to save certain institutions, banks especially, they push the pedal to the floor. Okay, and sometimes they back off a little bit, but then they push it to the floor again. Now, if you saw Powell today, he was comfortably smiling and talking about, we have these two mandates and the economy looks solid. Even the reporters in the audience were smart enough to say, yeah, but, when the stock market goes down, then the data points change. It's a point we've been making for many months. They don't turn first and then, the economy's getting worse, so the stock market goes down. Now, the Fed is going to have soon all the data points they need to smack them in the face to, again, push the pedal to the floor. And I know they don't want to because, frankly, they don't like Trump. He doesn't like them, so there's an antagonism there. And so Powell's kind of smiling right now because stock market's going down and he's not getting blamed for it by keeping rates too high for too long. Trump is getting blamed for it. So he's in perfect position. The problem is this, the banks. And look at an ETF like KBE, which is the major bank ETF. Look at Bank of America. Look at Citicorp. I mean, these banks are dropping enormously, far more than the S&P. In fact, over the last week, S&P would be down 3 or 4% one day, 3 or 4 the next. Banks would be down 6 or 8%, 10%, et cetera. And I'm not just talking 1 or 2, but the sector. Okay, that is a sector that few people are talking about for some reason, and that's the one that will provoke the Fed into panic mode, and probably not even waiting for a meeting. So I think that's where we stand right now, and I think that is an underlying explosive ingredient for gold and for silver. And we can comment on that a little bit later if you want to talk about silver.
Well, I would like to get into that because your premise for a long time has been that when we see a stock market crash, a lot of the money will move into precious metals. So it seems like right now we're seeing both fall at the same time, but you're seeing maybe that reversal happening pretty soon.
Well, if you look at the mama market, gold, right now as we speak, it's trading 3.5%. Okay, off of its high daily close, which occurred a week ago. But it's down 3.5%. Okay. Stock market was, look at, bank sector, stock market, and silver and commodities also going down because, we're going into a depression or something. Well, we might be, frankly. But there's a couple mistakes there. One is the assumption gold goes down with the stock market. Yeah, it could go down on a couple weeks here and there with the stock market in a sharp situation. But let's go back and look, for example, at that October of 2008 event. That's when the stock market had already been coming down hard for a full year and finally had a puke. Okay, and gold said, I need to correct anyway, so it had a puke. The Fed sat and watched the banking sector implode during the summer. I mean, the Lehman Brothers went under in September of 2008. Stock market collapsed the next month in October. And it wasn't until November that the Fed finally said, okay, we got to do something. They'd been cutting rates all the way down, but they did QE at that point. So right after that October collapse, a full month or two after Lehman went under, the Fed finally woke up, copied the Japanese model, and started doing QEs, November 2008. Stock market, by the way, went down for 5 more months into March of 2009, substantially further lower. But if you bought early in November, right after that October debacle, where you thought, stock's going down, therefore gold goes down, actually, gold stopped and turned and started to explode back to its highs within about 3 or 4 months, had gained from the 600s back to 1,000, like a 50% gain. Not because the stock market turned up, no, because the Fed hit the pedal. And that's what causes gold to move the way it does. Now, right now, If you looked at Powell today, they're not going to hit the pedal. He's just going to be academic about it and wait for the data points. I mean, when the blood's in the street, he'll finally see the data points. I strongly suspect that the phone calls between the major banks and the Fed have been increasing at a tremendous rate over the last week or so. Because it's not just one bank, it's all of them. They're going down much harder than the stock market. So everybody's talking about, oh, well, Tesla collapsed and Nvidia's down hard. Who cares? It's the banks that matter to the Fed. After all, the Fed is the banks, okay? Now, that's why gold's down 3.5%. Somebody's buying gold relative to the rest of the world. And I think that's because they see what's coming. The Fed has maybe learned a lesson since 2008 and learned, hey, we can't wait too long. We can't wait for an actual big bank to go under because then we'll look like idiots. We need to actually do a QE, start buying assets, start buying banking ETFs or whatever, bank stocks or commercial real estate's another implosion area before it becomes a bloody headline. And I think gold knows that. It knows maybe the Fed's a little smarter now and will implement their aggressive policies real soon. Watch the bank sector. That's the key. Now, the case is silver. Investors are making a big mistake there. Okay, if we're going into a major global recession, maybe a depression, wouldn't surprise me, given the bubble size of the US stock market, the Japanese market, and the Indian market, they're all imploding together. Industrial commodities will go down. Now, they don't necessarily have to stay down because when the Fed puts the pedal to the floor again, that money goes somewhere and commodities are still dirt cheap and we think they're going to go up. But right now they're going down with the stock market. Industrial commodities, crude oil, copper. Okay, they're treating silver not like gold. Like I said, down 3%. Silver's dropped from $35 to $29 almost in a matter of a week or so. It's behaving like copper and oil. Somebody's making the conceptual error that silver's an industrial commodity, not a monetary metal. So just fundamentally, now there's technical reasons for what I'm saying. Just fundamentally, if I were an investor wanting to put my money in monetary metals, knowing that the Fed's going to panic here, probably sooner than they did in 2008, that I want to own monetary metals because paper money is going to be far worth less than it might otherwise be because they'll accelerate the growth in the money supply. I'd look around and I'd say, well, gold's behaving well. Yeah, I'd want to be in gold, but that silver's ridiculous. It's a slingshot situation. It is not copper. It is not crude oil. Okay? It's a monetary metal. And right now, for the last week, investors have forgotten that. And they often make mistakes. Investment crowd often makes excessive mistakes either way. So right now, I'd say we see this pullback in gold and silver as a major buying opportunity. We're looking for the least excuse to define the upturn. And I strongly suspect it won't really take a full 30% crash in the stock market to do that. I think you got to watch the banking sector. If it doesn't behave well real soon, and already it's done so much damage, I don't think it will, the Fed will panic. And that's the name of the game.
Now, with respect to gold versus silver here, we see silver about 1% gold price. So 100 to 1 ratio of gold silver, which is almost unheard of. We saw once during the COVID crash, it spiked above that, but I don't think we've ever seen this in history before. So what is your perspective on that? And I guess maybe that trade of gold for silver at the moment.
Yeah. The silver gold spread has been trying to break out, as has the gold miners versus gold. In other words, when you plot the spread chart, and we do it like weekly in our reports, there's certain levels. If you can get GDX up to a certain level versus gold, it's going to break up a couple-year downtrend on the spread and say, okay, I'm back. Okay. Silver has a similar situation, and you're right. We're literally in the gutter historically in terms of price. So either we're totally wrong and silver is no longer a monetary metal, which I don't think is the case. And by the way, if you go back, for example, over the last year, for let's say March of 2024 to the close of last month, silver went up, the commodity index went up a slight amount, I think, during that year, a couple percent. Silver went up almost as much as gold on a percentage basis over that 12-month period. So silver was moving with the monetary metal, not with crude oil, which is laying on the floor for the last year, or copper. It was behaving like gold. And suddenly for this week, it's not behaving like gold. I think that's a mistake. Silver is the little puppy on a leash held by gold, okay? And I think right now it is in a slingshot position. Yes, there may be slightly lower lows next week, but I'd be watching right now for any sign of an upturn. There's another reason, technically. I used to keep point and figure charts. People, X's and O's, where you get upticks, you get downticks. Silver never tops with a double top. Well, we made a high at 35 back in October. We had a drop down to 30. So you had 4 downticks on a $1 chart. Then you went back up to what? 35 last month and this month. You put the upticks back on the board to 35. So you peaked at the same level you did last October. And now you've downticked again to 30. Almost traded 29 today. I actually want to see it trade to 29 and take out that last low. So people then pull their hair out. So, oh my gosh, it's no good. Because on a point and figure, when you do that, you set up a double top and take out the column low. Pardon me if I'm being academic here. And then you start to uptick. What it was a bear trap low, meaning you went down and took out the last low to spook people. And if you don't sustain and you start to uptick, you're headed for a triple top breakout. And I think that's what silver's setting up here, is a compression situation where it flushes everybody out without the help of gold. I mean, like gold only dropped 3.5% and suddenly turns and burns. And so I think watch gold, I don't think it's going to do what the stock market's doing or what silver's already done or what commodities have done. It's hanging in there pretty tough. And I think that says something. And I would focus on the banks because we know that that's the arena that will cause the Fed to not openly and publicly, but to quietly behind the scenes panic and probably even have a cut or QE instituted even before the next meeting.
Now, when it comes to the banks, as you mentioned, it sounds like that they're in trouble. Do you think this is for the whole banking sector or just some of the major banks here?
It could be, obviously, it could be one or two or here, three here or there, but I'll just look at all of them. They're all behaving very much the same. The only difference is some of them are down a little more than the others. Bank of America and Citicorp have dropped more than, let's say, JP Morgan or a few others, but they're all down hard. And the point is, it's not that they've been going down for a long time and therefore might be near the end of a decline. By our metrics, the decline just commenced, technically speaking, on quarterly momentum. It just broke late last month, early this month. So the game is just on, and they have a long way to go, and they're doing a lot of damage. And I can see some of the price charts that people are looking at saying, well, let's try to buy it here. It's ripping through prior pivotal lows freshly. So even the price guys should start to get concerned here. But I think that's the area that, again, it's not a headline. For some reason, they're still focused on the Mag 7. But it's the banks that are the one that really count. And the other sector that is very dangerous is commercial real estate. We've been pounding the table about that for quite a while. Not mortgage real estate, but commercial real estate, because that's a debt crisis arena. And there's a couple of ETFs on that, RWR and VNQ, that you can look at. And they own the big companies that own the shopping centers and the commercial centers and the computer centers and all kinds of things like that look like hell, technically. And they have a lot of debt. And we know that that could be an arena that impacts the banks if you start to have problems there. And so don't be surprised in the next month or so, you start to see some, oh my gosh, a headline out of the financial arena. And that's when the panic really sets, because when the public starts to hear that stuff, NVIDIA going down is one thing, but when you start to have banking problems, the Fed will panic and will the public. So I think we're near that point. So what I'm looking for is the stock market drop to actually explode gold, especially the banking sector, because that's when the Fed puts the pedal to the floor, and we're back in November of 2008. Forget the October drop. It's the November action by the Fed that took gold right off the page and went from 600 and something up to over almost 2,000 over the next couple of years. Despite the stock market continuing down for 2 more quarters, gold was back to its highs. So I think we're in that kind of situation right now.
Now, with respect to gold and silver, again, we've seen for the last couple months, outflows from the LBMA. Largely, as people say, that might be because of fear of Trump tariffs. So now that Trump has, confirmed that tariffs are coming, do you see that flow continuing from the LBMA over to the U.S.?
I'm not sure about that situation. I don't pay much attention to it because it's one of those that's transient. Yes, it's a big issue right now, and it probably does reflect incredible demand for the physical stuff. And that's interesting in itself because owning the physical stuff instead of the paper version of the physical stuff indicates concern. If you want to put it another way, panic. I want to hold the real stuff, okay? Not a piece of paper that's contingent upon certain things not occurring. Okay, so that could be an underlying statement of what's going on out there in terms of sentiment among large acquirers of gold. And right now, the public is really not, the American public in particular, has not gotten behind the gold bandwagon. They've missed a tripling in the price of gold over the last 15 years because they've been focused on the stock market. Now that bubble's starting to break. The question is, well, will gold go down with the stock market? Yes, in a brief period, it might. Well, for some reason, this past week, which has been disastrous for stocks, gold didn't go down 3%, if you want to call that down. So I think that the money flow is moving. And I think the silver situation is very unique because there's a mistake being made. One, it does move with gold ultimately. It does not move with commodities generally. Their historical correlation is not good. Its correlation with gold is very good. Right now, it's in a slingshot underperformance situation to gold. But I think it's a great mistake, which will snap back quickly. So when gold does start to outperform, my bet is it doesn't crawl back. It does something fairly explosive in terms of net price gain. So we're still quite bullish on the monetary metals. And we think this is a bear trap situation, especially for silver. And don't pay attention to the commodities in relation to silver. Pay attention to gold.
One last question with respect to the miners. Obviously, we're seeing a sell-off in the miners as well. Along with this, do you see that this could be related to maybe money managers moving into the space, or do you see this just kind of people are selling because of margin calls?
Probably the latter. We do know that leverage in the U.S. stock market is like triple its norms, okay? Or triple any prior time. I've seen studies on it. I don't pay that close of attention, but that's an interesting fact. And therefore, this drop, which is now maybe getting to the point of creating margin situations, but we do see a bounce point in the S&P, a potential bounce point. And it better well bounce from there. But that's down another, like we're trading near 5,100 today. The S&P looks like it might have a bounce point at 4,800. The Nasdaq 100 is trading in 17,500 area. It might have a bounce point in the 16,000 area. So a good handful of percentage drop, 6, 7, 8%, and you'll get to a possible bounce point. Not a low, but it could. But that's still not a crash dimension, actually. If you think about 30% drop is a crash in a matter of a couple of weeks. That's what happened in October 2008. And so far, though, we've had a sharp drop in stocks from the highs of a month ago, February, I think it was, to the present. It's still not crash dimension, and though you get a bad day here and there, there's not like a 30% drop. Who knows? Maybe we'll get it. Now, if S&P ever violates 4,800 substantially and closes a month out, like much under 4670, let's say, I'll give you a number. At that point, you're blowing some other momentum structures that say all hell could break loose. But right now, we tend to think you could have a bounce point around the 4,800. Now, that might get relief to the commodities, and silver might bounce. But right now, I'd be focused on gold and silver as basically the only place to really be when the central banks panic, realizing what is actually going on, especially with financial institutions.
So last thoughts then for our viewers, it seems like the broad overview might be that this shift that you've been talking for a long time of people moving from stocks into gold's showing strength, only down 3% when the stock market is down quite a bit more. So is that shift happening right now?
I think it's been happening ongoing for the last several months, where early money has been moving out of an asset category they deemed to be too high risk, too low reward, even though it hadn't dropped at that point, January, February. The money was starting to move. That's why miners, for example, shot up substantially over the last several months. In fact, XAU index and GDX, the ETF, if you look at the last 3 years of action since 2020, they blew that stuff out. It was a ceiling. And yeah, you pull back slightly below, but you closed last month substantially above it. And I'm going to bet by the end of this month, you're still substantially above that range that prevailed back to 2020. So their price action has just woken up. And I think more of that money will flow into the miners, especially as the perception hits that this really is a bear market in stocks. The talk of correction is starting to get a little wobbly right now.
Certainly. And if our viewers are interested in continuing to track this with you, olivermsa.com is the place to go. Can you tell us a bit about that?
Well, we cover all 4 major asset categories because it's important to do so. You can't just look at gold because ultimately gold is the inverse of paper money and it is the inverse of central banks. And when the central banks panic, gold explodes. And that's what happened back in the 2008 period. It was a major buying opportunity. And the Fed lagged a bit. And this time, I don't think the Fed's going to lag so much because when they see those banks coming down, they're going to hit that pedal. And I bet they don't wait till we have a failure. Another Lehman Brothers, which case I think it's right around the corner. And I think gold knows that.
Fantastic. Well, exciting times. Thank you so much for your time today here, Michael, and you have a good day and God bless.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for March 31st through April 7th, 2025, while supplies last. First this week, we feature 1-ounce gold Britannia at just $59 over spot. Next, silver Britannia are only $2.99 over spot. 1 10th-ounce platinum Britannia are just $29 over melt. And 1 10th-ounce gold Britannia are only $27 over melt. All of our specials this week are IRA eligible. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
In 2025, we are experiencing a market crash. There's a lot of turmoil in the market. And as you can see, my portfolio is down 19% year to date, and I'm down $800,000. This is full transparency on my losses. And I want to talk about what I plan to do. Looking at the market, what's going on, talking to friends, analysts, everyone is down right now. I don't know a single person that's up. So besides Michael Burry, who is an outlier in 2023, he's a little bit late, we're all down. And we have to think about what we can do right now. And I have several answers for you in this video. So I saw the market was a little bit shaky, which is why I put a lot of my money into Apple. You can see my Apple position is now down 2%. I was up hundreds of thousands of dollars on Apple stock, and I saw that the market was getting a little bit expensive, and I put a lot of my money into Apple. I put money into Apple because the PE ratio was lower than Nvidia and Tesla, and you guys know that I'm out of Nvidia and Tesla. I've been out actually weeks ago, okay, and I told my community the same thing. However, being invested in Apple has not actually helped a lot, and that's because the whole market is just correlated. Everything is down, and there are really no hideout places. And this is really difficult because when the market's down, we're all just kind of a sinking ship together. I'm not going to sugarcoat this. This looks pretty bad. The market looks like it's in a really bad spot, and what we're experiencing is a black swan event. The black swan event is basically happening because we have a surprise 34% tariff from China on US imports, plus restrictions on rare earth exports and anti-dumping probes. This has triggered a lot of panic in the market. I mean, we've had yesterday the 29th worst day in the whole stock market since 1980. That's how much panic there is in the market right now. That's how much of an issue this trade war really is. The fear and greed index is now down to 6 out of 100. 100 means there's extreme confidence and enthusiasm. 6 means there's there's extreme fear and panic in the market. And as much as this hurts, and I'm down so much money that I have to watch my spending now and probably pull back on some of the more expensive restaurants that I go to. I'm in Dubai right now. And I think a lot of us are going to have to face the same thing, and it's going to be uncomfortable. But there is kind of a bright side to this. The market is down so much, and I do think that we're going to get a recovery at some point, because that's what the market is. It always recovers. This is a game that's been around for 100 years plus, right? So we're going to recover. The question isn't if we're going to recover, it's when we're going to recover. And I want to go over some more details here. First of all, I want to go over NVIDIA stock. NVIDIA is now trading for under, well, pre-market here or over the weekend as I'm filming this, it is at 92.60. This is insane. The AI infrastructure play, which Dan Ives talks about all the time, many analysts talk about, are they all wrong? I'm not sure. I think the bigger issue is we have a trade war at the moment and the economy has some big issues. However, I think that NVIDIA is going to make money, and you can see right here that it's under the Bollinger Band. The RSI is 28, which is actually kind of bad because the stock can still go lower and RSI could be 20. So who knows in this market? There is no such thing as a technical support during a market crash. I do want to compare my performance though and discuss the mindset here, because one of your questions right now may be, I'm down a lot of money and Henry's a moron, Henry's an idiot, or F the president and the president's an idiot. To be honest, this is just part of the game. And the only way that you actually really lose is if you completely get out of the market. The other way that you really lose is only on a relative basis. So I want to check how much I've relatively lost to QQQ. So I want to pull up QQQ and look at the year to date. So I'm down 19% year to date. If I go to QQQ year to date is down 18%. So I can actually confidently say that although this sucks, that the underperformance isn't really there on my part. Haven't really underperformed besides the 1%. So I need you to look at your portfolio and ask yourself, how much are you down? And there's also a bright side to this, because don't get upset if you're down more than me, or if you're down more than SPY and QQ. It's actually okay, because a lot of folks right now in this market have risky stocks. And if you're down more, that just means that they're going to recover more when the recovery happens. Because oftentimes the stocks that are down a lot have a high beta. A high beta essentially means that there's a lot of sensitivity to the market. So when the market is down 1%, a high beta stock will, let's say the beta is 2, it'll be down 2%, which is why we see a little bit bigger of a pullback in NVIDIA and in something like Palantir. Palantir, by the way, I've been hedging as much as possible, but I got tricked by Palantir a bit with this pullback. And again, I don't know if tricked is the right word. This is a black swan event, which is affecting the entire market. I mean, someone that said, hey, SoFi is better than NVIDIA or Google, they're all down. They're all down. Meta, Tesla, Apple under 190. Apple is really the biggest surprise for me because it had a low PE ratio and I had a majority of my money in Apple. But hey, nothing is safe in this market. So I think what you should be doing right now is don't panic, don't buy puts, because I think, look, if you buy puts, right, and the market's up 5% in 3 months, which is very possible, just so you know, in 3 months, the market could be up 5%. If you spend 5% of your money buying put options, in 3 months from now, right? Essentially, when the market's up 5%, you spent 5%, you're not gonna make anything back. So right now, I think it's a good time to have exposure. And the only unfortunate thing is I really wanna buy more stocks. I would love to buy more stocks, especially some value stocks. However, I don't have any cash because it's hard to dollar cost average and it's hard to put money to work when the market goes down like 7 weeks in a row. I just don't have any cash available. However, I'm going to keep holding everything that I have. And just looking at information technology as a sector, it is the most exposed to foreign goods and it is very vulnerable to the tariff environment. So that's why, if I go to my portfolio here, which is down essentially as much as SPY and QQQ, so can't get too hard on myself. The positions that I have right now, I'm trying to be a little bit more light on growth stocks, and I've been saying that, by the way, for weeks. Although I couldn't predict this crash and nobody could, I have protected as much as possible and actually done what I would say a pretty good job at reducing, high beta stocks and high growth stocks, but it hasn't been that helpful. Like you can see, Kraft Heinz is down 4%. I mean, I invested in the ketchup company that Warren Buffett has. Huge value stock with lots of dividends. It's down 4%. So it's being being a smart investor right now doesn't matter. It just doesn't matter. It's kind of like learning how to properly drive a car and how to properly turn and park, doing parallel parking when cars weren't even invented. Right now, it doesn't even make sense to try to predict, to try to hedge, to try to protect. Because the market is down so much, this is a proven buying opportunity. Essentially, that's what it is. As uncomfortable as it is, as much as this sucks and as much as to be honest, I'm a little bit at a loss of words because it's not easy, but logically, the path is pretty clear. Like the path is very clear. It's very obvious what to do, okay? Buy Apple. Walmart, which is also down a lot, one of my best plays, down to $83, be purchasing it. Amazon, I still think the consumer is strong. We actually saw some really strong job report numbers, which is a good thing for consumers. However, I want to say that it is bad news for the market in a way because it does discourage the Fed from cutting interest rates. So one thing that we can look out for is the Federal Reserve cutting interest rates to make stocks more attractive, but they're probably not going to do that. You know what else is good news though? The market's going to go up. The only question is when. So a lot of the numbers that we see right now are like vanity metrics. My portfolio is not at 4 million anymore. It's at 3.37 million, but it's going to be at 4 million again. And then I can pat myself on the back and say, great, we made money. Is that gonna happen in 3 months, 6 months, 9 months, 1 year, or 16 months? I don't know, but it will happen. So I think that's my plan right now. My plan is to do a lot of nothing, is to participate with everyone else, is to stay invested. I did invest a good amount of money into XLC, which is like the communications ETF. It has a lot of meta. In fact, let me look into XLC real quick for you, because I do want to still have exposure into the market. Like, you have to. If you stay in cash and you miss some of the best days in the market, you know, everyone talks about that. Dollar cost average, stay invested. I'm not gonna say the most boring, typical stuff that a Dave Ramsey or the other YouTubers that you guys watch would say. That stuff is obvious. But the thing is, the obvious stuff you have to do right now. And for me, I am invested in the market through XLC at the moment. I put in $437,000. Well, actually, I put in 500K, but it's down to 437,000. You will notice though that I did do a covered call, which is up 99%, or it was up to 99%. I think there's a little bit of a glitch right now on Robinhood. I'm not sure why this. Oh no, this actually expired. Yeah, so I'm making this Saturday morning. So no, this is correct. So I made $7,000 hedging on the downside. Same thing for Apple, by the way. So I've actually, let me show you my Apple position. I've done actually pretty good because I have call credit spreads, but still I got some sell puts. So of course I'm going to be, yeah, I think the whole conclusion of this is everyone's down. It's okay to be down. And yeah, don't beat yourself up for being down. Like, that's normal right now in this market. Donald Trump's down, by the way. Everyone's down. Nancy Pelosi is down. There isn't a single person that's not down, except for Michael Burry. Of course, Michael Burry predicted the market in 2023, so Michael Burry actually did a good job, but his timing was a little bit off. I think we're in 2025, guys, so 2023 was a little bit off. AK, I'm joking. I'm saying everyone's down, including Michael Burry. Michael Burry's up right now, but he was down for like the past 2 years being a bear. You know what did work kind of well, better than nothing, is Apple, like covered calls. So I sold some Apple covered calls here, 850, sold some more Apple, 8,900. I mean, I've been selling covered calls. I mean, 8 grand, 8 grand, 5 grand. I mean, it's been okay to essentially sell options. And you can see here that I sold Apple for a lot. You see it says 51K, but I made 22K, 6K, 10K, 19K. I've been making pretty good money off of covered calls, but again, it's just not gonna save, it's not gonna really save a whole lot. My 1 week performance here is, so I'm clicking 1 week. Oh, let's click 1 month. There's a little bit of a glitch on Robinhood. So 1 month is negative 16%, 1 week is negative 9%, and year to date, negative 19%, which is actually in line with SP 500 and QQQ. On the 1 week, I'm down 9%. Let's see how much SPY is down. And again, I'm just pointing out that as long as you're down as much as like the index is down, yeah, so 8.5% down, and again, I'm down the same as SPY. Pretty good, actually. So anyways, this is an awkward video to make, but it's a truthful video to make on losses, on the difficulties in the market, and I just transparently wanted to show you my performance. I mean, I think a lot of people right now are still making some hype videos. I want to be honest and make some loss videos, but we're going to get some recovery, and I'm sure of that. So yeah, I'm going to make more videos, and we're going to continue our journey. And if you know what? I should have said this earlier. Why did I wait till the end of this video to say this? If you zoom out, this crap's not going to matter. This crap doesn't matter at all. When you zoom out 2-3 years down the road, this is not going to matter because we're going to be up a lot more, and my portfolio is going to be at 5 million. That's for sure. So if you zoom out, this literally doesn't matter. And that's why, as hard as it is to make this video, it's also easy to make this video for me personally. It's easy because although I have to change some of my spending, and although being honest, and some of my comments will be like, oh, Henry's a moron, you lost money. We all lost money, and it's okay because when you zoom out, we're gonna not really care about this down the road because we're all gonna be up as long as we stay invested. And I know I'm gonna make money. It's just right now I'm not making money because no one's making money. But when the market goes up, I'm going to make more money than everyone else, as I usually do. So my confidence is still literally the same. All right. So same confidence, same mindset, and we'll get back to chugging along and getting good results when the market recovers. And that's gonna happen pretty soon. Right now, we're gonna have to wait and be patient, and that's very hard as an investor, but part of the game. We have to experience the bad to experience the good, and there's no amount of videos or news that you can watch to change this outcome. So if you watch more videos on YouTube and news or politics, it doesn't do anything. You're just wasting your own time. Instead, go enjoy life in some way, spend time with your family, and save as much money as possible because dollar cost averaging is the best strategy if you have cash, which none of us do. So if we can get our hands on some cash, invest it, and wait for the recovery. And I will be making videos on what stocks to buy, what stocks I'm rotating into. Doesn't matter that much right now in the market because everything's super correlated. Housing is, by the way, correlated as well. So the people that say, real estate investors that say, oh, real estate's safer, like, no, it's not. That's the same thing as stocks, except that you have to do more work as a real estate investor. Whereas stocks, you just press a few buttons and you do it from the comfort of your house. So yeah, I'll make some more videos. If you appreciate this brutal honesty and transparency, yeah, I mean, probably subscribe if you're not subscribed. Either way, I'll keep making some videos and we will find the best path moving forward, whatever the best path is, which is dollar cost average. Zoom out and imagine what our portfolio is going to be in years to come, which is pretty much guaranteed to be good. It's pretty much guaranteed. It's going to be good. So anyways, hopefully you enjoyed this video and be patient. It's going to come back for sure.
So this white X represents where I got JP Morgan. So can you guys see some reasons? Now remember, this is for the newbies, and those of you that have been around, I know that you already know this. I do not trade options, swing options, unless there is a clear definable setup. What is a setup? A series of criteria that you can stack on top of each other that give you a true edge over something happening versus it not happening. Does it guarantee that the trade will work? No. But you're building a case the way a lawyer builds a case, right? Evidence. Give me evidence. Well, I saw the man run out of the apartment with a red shirt and he had a knife in his hand. Okay, what else? That's all they got, right? So they got to do DNA, they got to check the security cameras, there has to be a motive, was there another witness to corroborate that one, et cetera, right? So evidence, you have to have a preponderance of evidence. And unless you have a preponderance of evidence, the judge may not let you even take it to trial. So there's usually like a pre-trial conference, right? Attorneys that are out there, and the judge makes the determination, is there enough evidence to go forward with trial? And typically the prosecutors, right, in the district attorney's offices, they won't even bring it in front of a judge to be embarrassed. They won't even spend the money and the resources to put it in front of a judge to go to trial unless they feel like they have enough evidence, right? So it doesn't mean this guy's going to get convicted, but they got to line up as much evidence as they can. When a doctor does a proper diagnosis, right? Well, my nose is all stuffy. Oh, you've got COVID. Hold on there, medico. Right? Do you have a fever? Do you have a cough? How long have you had it? Do you have allergies? Do you have a coke habit on Saturday nights? Like, why is the nose stuffy? Right? Even doctors have to build a case so they can determine what the best course of action is, so that they can get a diagnosis. Am I hitting any bells here? Ding, ding, ding. You guys get it or what? Yeah, makes sense? I think it makes sense. Okay, so for me, I need to trade with a setup. So what was the setup for JP Morgan? Glad you guys are with me. Oversold on what chart? Nova, nice comment. Yeah, Margie, it's not just a line. Okay, that's